Even more detail is coming next week. But as I move towards my big annual event at the end of November, I want to reach back and I want to give some inspiration, some mindset, the way to think about odds, chance, luck, and psychology. What I am about to play is not exactly trading, but it's exactly trading. Again, even more is coming next week. But as I prepare for the end of November, for a transformation, to help transform as many people as possible, let me give you something, a blast from my past, to wake you up and to remind you. My guest today is Annie Duke, professional poker player, entrepreneur, author. Today, we talk psychology. We talk expected value. We talk loss aversion. We talk decision making. The parallels between her world of poker, the decision making in the corporate world, the decision making in the trading and investing world, the decision making in the VC world, the crossover is absolutely amazing. I hope you enjoy this conversation with Annie Duke. So Annie, I have to tell a quick story why we're even talking today. Sometime in 2007, I was in Macau, China. I was on a ferry going back to Hong Kong. I heard a group of people ask a guy what he did for a living. I caught wind that he was involved in ESPN and poker programming. I tracked him down at customs in Hong Kong. I said, listen, I'm doing this film. I'm talking to all these traders, all these investors, and all they keep talking about poker and these connections to poker in their investing mindset. And I said, listen, you got to help me. I need to land some people in the poker world. And he looks at me like, who are you? You're like a stalker in line in Hong Kong. He said, I wrote these books. He said, well, what book did you write? I said, well, I wrote this one book called Trend Following. He said, oh, I read your book. Okay, I'll help you. And that was how I ended up in the house of a very nice, tall guy in Las Vegas who gave me some great understandings about psychology and odds. A tall guy that I think you know.
That sounds like my brother.
Exactly. And the guy that I talked to was Matt Moran's.
Oh, okay. Yeah, he's a great guy.
Yeah, so it was completely random that I'm like finding this guy on a ferry coming back from Macau to Hong Kong, right?
Yeah.
Yeah, crazy.
That's great. Yeah, once you say tall, it's like, all right, well, it's Eric Seidel, Howard Lederer, or Phil Hellmuth.
Yeah.
So.
Yeah, that was.
He narrows it down. So I assume if you're telling me the story, it must be my brother.
And so that was the only way I was able to, all these years later, send you a little email and say, hey, by the way, I talked to your brother. And so this crazy small world that we all live in. I want to know, though, from you, someone who's very well known for this pursuit in her life, poker, but at one point in time as well, pursuing the PhD in psychology. I want to kind of where it started your odds thinking. Was it even before playing poker that you started to reformat your mind to think in terms of odds?
That's interesting because you're asking for me to recall something. And one of the topics I think about a lot actually is how bad our memories are. It's very difficult once you know something to sort of recall when you didn't know it, right? That's actually a problematic question for me because I have spent so much of my life thinking about things as probabilistic that now if you ask me, I'll give you some kind of answer like, well, I imagine when I was 7, I didn't think that way. And I know that when I was in my 20s, I was thinking that way. The stuff in between, I don't know, like we were playing cards all the time. We were playing games all the time. So that concept of chance and volatility was pretty prominent in, our everyday activities. I would imagine it was in my thinking. Did I start expressing that in any kind of explicit way? It's hard for me to say because that's the frame within which I think about everything now. So it's very hard for me to go back and say, well, when exactly did that happen? I think that as humans, we're incredibly bad at that. So actually in that relation, I was just, for some reason, my boyfriend and I were talking about Y2K this morning. And he said, I would love to ask people now if they thought that Y2K was really going to be a problem and compare that to the numbers of, compare that to what they thought the day before Y2K, right? Because we're just kind of bad once we have a belief. We sort of think that we believe that way all the time.
Right. It was the end of the world. I've seen the question posed to you. Do you look at things all day and go, 18.5%? And clearly you do.
I do. Yes, pretty much. I think that it's actually incredibly important to think that way, because if you're going to be a good decision maker, you really have to be thinking probabilistically, because you have lots of alternatives in front of you all the time. One branch of that tree is not 100%, even though it might sort of feel that way, because what people are generally saying when they say, that's 100%, is what they're saying is it's highly likely. That's what they mean. If you're not considering the other stuff that could happen, I think that a few things happen. Number one is that you tend not to consider them because you've sort of assigned, like, let's say you think something's 80%. You'll just say, that's 100%, because you just sort of round up to, I'm pretty positive is what 100% means, I think. You don't consider it stops you from looking at what the other 20% is, which I think is bad. So I think what happens is that when you think that something's going to happen the majority of the time and you default to, that's 100% to happen, that actually prevents you from considering other alternatives. And when you actually explore those alternatives, you can come up with some pretty creative solutions. And sometimes you figure out that the thing that you thought was 80% was not actually 80%, because when you go down those other branches of the tree, you realize some new things. So once you default to 100%, you're not considering other choices. But then I think the other thing that happens that's really bad, which I think in some ways might be worse, is that when it doesn't work out then, when it actually turns out that it doesn't happen, so by definition it wasn't 100%, now what you do is you just assume you were wrong. Instead of having explored in advance, this was 80% and then 20% of the time other stuff was going to happen. So now when it doesn't work out, it was the other 20%, and that doesn't necessarily mean that my thinking was incorrect. So you're much more likely to change your behavior, I think, in a way that's actually not productive when you assign something 100%, because then when it doesn't happen, you just assume you were wrong. This is something that I really train my kids in, because I think it's actually extremely important. When they say things like, I'm 100% to get the job, like I went into the interview and I did so great and I'm 100% to get it. I'll try to get them to think more clearly about what their percentages are. When my son was going in for his driving test, he said he declared 100% on passing it. And I actually got him to think a little bit better about what do you think? What are the chances really? He actually didn't pass it on the first try. So, those kinds of exercises I think are really important to go through.
This starts to lead into a little more depth of our conversation. And I'm thinking back to the first time that I was exposed to the concept of mathematical expectation inside of trading. And it was the biggest light bulb moment. It was like, wow, okay, this is how people are really thinking. And I'm sure, and from the poker perspective, the moment that you really kind of saw that was what the top minds were doing, the top players were doing, and having that edge was so critical, and thinking that way. But that's very difficult for people, isn't it?
Well, I think it's really hard. I had an advantage coming into poker because my PhD work was in science. Psychology is a science. We were thinking about expectancy all the time. Mm. And, you're thinking about, in that case, you're thinking about p-values, which really have to do with confidence intervals. Different sciences have different p-values that they allow. In psychology, generally, 5% is okay. If there's a 5% margin of error, you're all right. In physics, you'd want it to be less than 1%, much less than 1%, before you'd have any confidence. And it just depends on which science. So that idea of confidence intervals and that different sciences were demanding different levels of confidence before you'd accept the result. Those kinds of things, that was already in my thinking. Trying to figure out what expected value was already in my thinking. I went into poker with that mindset, but it is something that absolutely separates out the top thinkers from everybody else, right? This idea of expectancy and really thinking about things in terms of, what is your expected value over time? What's interesting, I've actually thought about this quite a bit is, what colloquially, what does good luck and bad luck mean, right? I feel like for people who are traders, good luck and bad luck means something very specific, which is that I had positive expectancy and I had enough iterations that I really should have realized it and I didn't. As an example, if you're laying me 2-to-1 on a coin flip and I lose the first time, I wouldn't call that bad luck, right? I have positive expectancy there, but I haven't run enough iterations in order to realize the game yet. But if you're laying me 2-to-1 on a coin flip and we flip 50 times and I somehow manage to lose, I would consider that unlucky because now I've really gone against expectancy and I've certainly run enough iterations that I'm way out at the tails. But I think that colloquial the way that most people use it in everyday life is bad luck is kind of like a bad thing happened. And good luck is kind of like a good thing happened. And in some ways, I think even if they get sort of past that, they'll sort of think of it as, I think that they think about things as, there's sort of 50-50, right? So like if you're above 50% and it doesn't work out, that's bad luck. And if you're below 50% and it does work out, then it's good luck. And, I think that would sort of be the next step. But I don't think that most people get beyond that step. And so, I think the question is when you're thinking about luck, versus skill, sort of how deep into the thinking about expectancy are you getting?
And that also brings us into this, as you describe it, outcome blind. I mean, process versus outcome. So many people in whatever walk of life they're in, even I'm sure many top executives that you deal with today, it gets this fixation on outcome, whereas they should be turning on its head and saying, hold on, what's our process?
Well, I think that that's incredibly important. I think that for several reasons. Reason number one is that when you focus on outcome instead of process, you actually reduce innovation in your company. And the reason for that is that innovation requires failure. Innovation requires a lot of bad outcomes because innovation is very high volatility. You know that you're going for a big win, but in going for a big win, you're going to have a lot of losses along the way. If you, as a manager of human resources, are very outcome focused, you will create in the people that are working for you a motivation to create a lot of wins, a lot of good outcomes. But that reduces actually your expectancy. So you have to tease those two things out. If what you're trying to do is book the biggest number of wins that you can, that does not mean in any way, shape, or form that you're maximizing expectancy. And very often you're actually, in some ways, minimizing it. So you can think about a poker analogy where what would happen if my goal was to just win a lot? Well, what I would do is I would go in and play, and any time that I got to above 0, I would just quit the game so that I could mark the win down in my books. I would go in, if I happen to win the first hand, I would just quit because I'm not going to risk losing that win. I'm just going to mark it down as a win and I'm going to leave. Now you can see, I assume right away, how that's not a winning strategy, right? Because what happens when I lose the first hand, by the way? Now so my losses there are going to be much bigger than my wins because I'm just taking a lot of small wins. So I could actually look over the month and say, look, I played 20 days and I could win, 16 of them and still end up, either losing for the month or maybe winning a very small amount where I wasn't actually maximizing the amount of time that I was playing at the table in some sort of positive expectancy situation. You could see that, for example, in sales where people are closing sales at a much lower number than they could actually be getting. Just to be able to say, I closed this many accounts, I closed this many people this month. They would for example, be sitting in a zone which was incredibly far from ever breaking a deal in order to make sure that they were getting wins, that they're actually closing the wins. And that's leaving a tremendous amount of money on the table. If you never ever break a deal, you have to know that you're doing something wrong. So you can see how that can happen. And when you look at how does, say, a startup come in and beat, a very large company. So how does like an Apple come in and completely, crush an IBM when an IBM can afford all of the talent, they have the market, they've got the eyeballs, they've got the consumers, they've got all of that. And it really, in a large sense, comes down to this question of how outcome focused are you. In a startup environment, failure is expected because what you're trying to do is something that's incredibly high volatility. You have that mindset that it's high volatility and failure is totally expected. So you can get incredibly big innovations. In a very large company like IBM, where people are having to answer, usually in some kind of quarterly fashion, you're not going to get a lot of failures. It's going to be about like all of these small wins, and you're going to lose the innovative side of the business. That's an incredibly important thing about being outcome blind, is that it allows people to focus on good process, which actually fosters innovation. The other problem with really focusing on outcomes is that you tend to change course too quickly. An outcome does not necessarily mean, a bad outcome does not necessarily mean a bad decision process.
As you brought up tech and you talk about bad outcomes, I thought there was a different way to look at it as well. If I think about all the venture capitalists out on Sand Hill Road in Palo Alto, they're looking at it and saying, we know we're going to fund 20 startups, but we also know there's going to be a very high degree of failure. And so that big winner that comes from, if they fund 20, let's say 19 bomb, and they're hoping the big winner, the one big winner, will pay for those 19 losers. So it's kind of another perspective to look at it.
Yeah, I mean, you go into a bunch of startups and 19 of them fail and one of them is Uber.
Exactly.
So, actually that relates to something that I actually teach in poker and then expand out to teaching everywhere else, which is, what I would say to people in poker is that people think far too hard when they're playing poker about whether they have the best hand. They really, this is something they think about all the time. Do I have the best hand? Do I have the best hand? And I try to tell them that 0% of the time should you be thinking about whether you have the best hand. What you should be thinking about, rather, is whether you can win the hand enough of the time. Now, that's a really important distinction. I'm not really going to think very hard about whether I can get to 100% on whether I have the best hand. What I'm going to think instead about is, can I win the hand enough of the time for the return that I'm getting? So I tell them, for example, there's a form of poker called limit poker, where the pricing situation can get very big. By the end of the hand, you can be in these 10-to-1 situations where for every dollar I bet, I'm going to win $10. 10 to 1 is pretty nice. And I say to people, I just don't spend very much time thinking very hard about whether I have the best hand in that spot, because if I have the best hand 10% of the time, I'm winning a lot of money. And built into that is that, I can lose 9 times. And that's okay. Like, I'm winning a lot of money because if I win the hand 10% of the time, over the long run, I'm just going to, my bank account's going to grow because I'm getting 10 to 1 on the investment for my dollar. So why would I think very hard? Because I could sit there and think for a really long time, but 90% of the time I'm allowed to be wrong and still make money. Instead, I shift my thinking to, basically, is there kind of a chance that I can win this hand? And if my answer is, yeah, there's kind of a chance that I can win this hand, I don't really think past that point. I just go ahead and invest it. So I think that that's how venture capitalists are thinking as well, right? Like, I kind of know that when tech companies win, they really win because they're like Uber or Angry Birds or something like that. I don't have to think too hard about whether this particular company that I'm investing in is going to win. I just have to think about how often I need it to win in order for me to be profitable to the kinds of decisions that I'm making. So they could make a decision that they think the company is going to succeed 25% of the time, and they're totally fine investing in that. That means 75% of the time that company is going to fail, but that's totally fine with them. They just need to get to 25% and they're okay.
Or if you're winning 30 or 40% of the time or even less, I think sometimes many people unfamiliar with this type of thinking, they don't see that your winners are going to be much larger, even though the percentage is lower, and they just get fixated on this percent winning. And the percent winning doesn't tell you anything alone by itself.
Exactly, and that's that outcome dependency. Yeah. Because obviously what part of the process is thinking about what your return on investment is, right? You have to think about ROI. I have people come to me and they'll say, like, well, I try to make sure that I win when I'm playing 90% of the time, and I'm like, I don't even know what that means, right? Like that, I don't understand that thinking. And I've done seminars with people who are really firmly intermediate players who have been playing for a long time. They've been playing for a decade, and they're pretty dedicated players. They're not necessarily professionals, but these are very avid, recreational players. So they're playing a lot. They're also willing to spend a lot of money to have come to a seminar with me. I don't do poker seminars anymore, but I did them for many years. So they were willing to spend a lot of money to spend a weekend learning poker from me. And part of what we would do is we would sit down at tables, and there'd be an instructor at each table, and they'd actually be playing cards, and you would be, deconstructing the hands for them. And I would always start off asking them a question in the first hand: how much money is in that pot? And they'd just look at me like, what? And then I would tell them, and they'd look at me like, how do you even know that? I would say, well, there's 5 people in the pot. I announced that, and you're all in for, everybody got 150 in before the flop. So there's at least 750 in there. And then there's some antes and blinds, which you can kind of estimate out, or you can come up with the exact number if you want to work that hard. That's fine. And I said, but how can you possibly determine whether you should bet or call if you're not tracking what's in the pot? Because in poker, the pot's the market. It's telling you what your return on investment is, right? So if I know there's 750 plus in the pot, and you now bet 300 at me, now I know there's a little over, there's about 1,100 in the pot, right? Because there was 750 plus before, so now there's 1050 plus, so let's call it 1,100, and I have to call 300 to win that. I'm getting a little over 3.5 to 1. So that determines for me, okay, if I'm getting a little over 3.5 to 1, that means, if I'm winning 25% of the time, I'm definitely in profit. If you're not doing that stuff, then what you're doing is exactly what you just described, which is you're tracking the percentage that you win, but not understanding that actually determines whether you're winning or losing. I try to explain to people, like, I can set up situations where you're winning 60% of the time and you're losing to it. And I can set up situations where you're winning 10% of the time and you're winning to it. Because the percentage of times that you're winning is only relevant in relationship to what you're getting in return.
Let me shift this to Daniel Kahneman for a second. Obviously, he's become extremely well known. I've had him on this podcast. Great guy, very interesting, very bright, of course, Nobel Prize winner. If I look at what he's done, it's helped the business world, it's helped the trading world to have this kind of this behavioral understanding of what people are doing in terms of perhaps even their betting strategy, their trading strategy, their investing strategy. But there's not it's a dense subject. I mean, there's little things we can break apart, like the disposition effect. People sell their winners and hold on to their losers. But what I like about the one thing that you've taken from poker that I think you're applying out in teaching people beyond just the poker world is the concept of tilt. And if you could explain that from your perspective and how you are bringing that out, because I don't think tilt exists in the trading world in the way that I see it discussed in the poker world.
I appreciate that question. Actually, that's a very good question, because I think it's something that is underappreciated. Yeah, so I haven't played poker for 3 years. Actually over 3 years now. What I do instead is I go talk to people in all sorts of different areas, a lot of finance, a lot of human resources, sales groups. I've done a lot of work in the energy sector recently, which actually Tilt applies to right now. So I talk to all these different industries because obviously when you're talking about behavioral economics, these are general things about the way that people think, right? We're talking about very robust processing errors in the way that we think, we process information, we come to conclusions, in the way we remember things, in the way we imagine things. It doesn't really matter what industry you're in, the concepts are going to apply across. What I think about is not specific to poker. It's actually specific to the way that the human brain works. Now, the reason why poker is a really good place to be looking at this stuff is because when we think about the definition of game theory, which is decision making under conditions of uncertainty over time, happens to be a very good definition of the game of poker, which is not accidental, because John von Neumann, who's the father of game theory, modeled his original thinking on that topic on the game of poker. He was actually an avid gambler. And he understood the difference between a game like poker and chess, which had to do with this uncertainty piece, right? And the uncertainty comes from two places, hidden information and volatility. The question is, what happens to people when they're making decisions under those conditions, right? You have hidden information, it's volatile. Those two things combined create a problem, which is you don't really know what's in your control and what's out of your control because you don't have perfect information. If I lose to you at chess, I know exactly why I lost, right? We can go back and analyze the situation. I can't shift it off to luck. If we come up with a game in between that has complete information but volatility, like backgammon, where you have the dice now, people can pawn it off to, I rolled poorly. Even if they lose over time, they can say, I rolled below average, right? So they can pawn it off to luck. Obviously in poker, you have the deal of the cards. Now what's interesting that happens to people in poker is that when they lose a hand where they are very sure that they were positive expectancy to the hand or a couple of hands in a row, the ball goes against them, what we would call unlucky. They perceive that they got unlucky, they will go on tilt. Tilt is a word that essentially means I'm so emotionally distressed by something that has happened to me recently, most likely something that I perceive to not have been in my control, that I will now make terrible decisions going forward because I'm in an incredibly hot state and my limbic system is totally lit up and my frontal lobe has now completely shut down and I'm ruminating on how unlucky I am and how I never win at anything. Now I do all sorts of ridiculous things going forward because of that. And we have wrapped that up into a nice little one-word ant thing called tilt. I guess much like the Eskimos have, more than 30 words for snow, tilt is a very important concept to poker players. The reason why I think that people don't really think about tilt applying out that much is because people think about one particular type of tilt, which I sort of term as extroverted tilt, which means people kind of go crazy. They'll really increase the volatility of their game in an attempt to do one of two things. I think the main motivation is really to try to get their money back. So they get into a losing position and they seek out volatility. And of course, you've talked to Kahneman and you know that that's exactly what people do. When you give people a low volatility choice versus a high volatility choice, on the winning side, they always take the low volatility choice, right? Because if they were to lose to the volatility, they would frame it as a loss. You can take $100 or you can roll the dice and half the time you'll get 0 and half the time you'll get 200. Everybody takes the 100 because they would frame the downside as a loss. Whereas on the losing side, they seek out volatilities. You're going to have to pay $100, say for a parking ticket, or you can roll the dice and sometimes you'll pay 0 half the time and half the time you'll pay 200. Obviously the expected value there is the same either way. But on the winning side, they say, no, I don't want to roll the dice. And on the losing side, they say, yes, I do indeed want to roll the dice. Because they've already kind of booked it as a loss. So if they win to the volatility, now they get a chance to book it as a win. And I think that that's what poker players are doing when they get into these losing positions. and they seek out volatility. They're doing the exact same thing. They also say things like, if you can't beat them, join them. Like they just decide like, oh, that guy beat me with such a bad hand. I'll just start playing bad hands too, and I'll show them. And I think there's a little sort of imagining Schadenfreude that gets in there too, that like, oh, when I get to turn over the bad hand on them, they'll feel bad too. And then all will be right with the world.
What I like with the tilt phrase, though, the word tilt, is that it just brings everything down to this understanding, this self-awareness, where it seems in the poker world, people can, not everybody, of course, but a significant number of people understand that this emotional out of control state can result. Whereas I don't see that type of phraseology in the investing world or the trading world, where people are doing that self-awareness. They know there's a ton of trading psychology books out there, so people know about it, but I don't see that kind of great phrase to just be like, I'm now in the state. I'm here. I know I'm here now.
Right. And I think that part of the reason is that in poker, you're making these decisions so quickly that it really comes out in a way that you can see it so well. But one thing that people don't think about very much in poker that I actually think about a lot, and we actually discussed it already a little bit, is once you get out of the losing position. So I've been in this losing position and it's happened to me a few times, and I've gone on tilt in the way that we think about tilt is seeking out appropriately high volatility to try to get your money back. And I don't mean appropriately high volatility meaning it's a good idea. I mean, given how much you're losing, you need a certain amount of volatility to get lucky to it. Not a good strategy. Just want to make that clear. That what will happen is once you've sort of cashed out of the position, there's all this work that's done on, the pain of paying, right? And how the pain of paying is very hard for us. And we do a lot to avoid the pain of paying. But when you really have a very strong memory of the pain of paying, what will happen is that you will actually get this other kind of tilt that will happen, which is not a short-term problem. It's actually a long-term problem. If you could choose between one or the other, you would take the short-term problem where you're just seeking out vol. It's easy to see. It's easy to spot yourself, and there's a lot of physiological cues to it. Basically, what happens is all of our biological functions ramp up. Your heart rate goes up. Your palms will sweat. Your cheeks will flush. You'll actually feel hot. And when you start feeling those things, if you become very good at recognizing that you're having those physiological responses, you can get up from the table and walk away. There's a lot of strategies you can do in order to avoid it. You can start focusing. You can start engaging your frontal lobe by focusing on actually analyzing the hand that you lost, as opposed to just ruminating on your bad luck, so making it a useful experience. And once you do that, once you engage your frontal lobe, it actually will shut down your limbic system, because those two things actually stand in opposition to each other. That kind of tilt is actually relatively easy to deal with. The long-term problem is that you actually become volatility avoidant. Once we've experienced sort of in too intense and and really kind of too many times that pain of paying, we'll actually start behaving in a way that avoids the pain of paying, which means that we make conservative choices. I've already described to you how that happens at the poker table, right? We are very, very likely, the minute that we feel like we're winning, to quit the game, to find excuses to quit the game just so that we can book the win and feel that, the happiness that we get from winning, so that we can avoid that pain of paying, which is losing. And now we play in a way that just avoids that. Now, there's lots and lots and lots of examples that we can see from that. We all know people who have gotten out of a bad relationship and then just stop asking people out because they don't want to feel the pain of being rejected again. That's like a very simple example of how people go on tilt. You can set up structures in your company that will actually encourage kind of both kinds of tilt, in the sense of, what you'll generally see, like in the trading world, is that if somebody's in the top, so let's say someone's in the bottom 25% in terms of performance for that year, again, you're not thinking about process, you're only thinking about outcome here. And we know we're coming up on the end of the year, you're going to tend to see them making much more high volatility choices than someone who's in the top 25%, who probably is actually going to be making choices that are really too low volatility in order to maintain that position, because they're going to feel like the bonusing is going to be dependent on outcome and not on process, which of course it shouldn't be, because what should matter is if you're on the gold desk and someone else is on the mortgage desk and the person on the gold desk wins a lot more, that doesn't mean they traded better. The question is, you could ask, I guess, what would happen if they switched? You could ask a different question is, how did people on a gold desk at another firm do? And how did someone on a mortgage desk on another firm do? Because for example, there might have been more volatility to trade in gold than on the mortgage desk. So you should really be looking at process there. If someone's in the bottom quartile, they're going to be probably displaying this tilt behavior of seeking out volatility, and then you'll get the opposite on the top quartile. You see this in traders actually all the time who have now gotten out of the position because they were losing. And now you see people who sort of like all of a sudden, like they used to be a good trader, they kind of went on a losing streak, and now what's wrong, I don't understand, because they were so great before. And what you'll generally see if you really dig into it is that they're making choices that are way too conservative, that are too low vol, just trying to avoid that state of pain, of being in a losing state. And that's very hard to see, because if you think about it, it's like sometimes it's correct to take the more conservative line. Sometimes that's right. We know it's not right all the time, but on a given instance, I can probably give you a very good explanation of why I might be making a choice that's conservative. I could give you a very good, in poker and trading and whatever it might be, I can give you lots and lots of good rationalizations for why I'm taking the conservative line of the choices that I have. So the only way for someone from the outside to spot it is to really watch what happens over time and see that every time I'm giving a choice between higher volatility and lower volatility, that I'm always choosing the low vol line. And then when you see that, you can see that I'm on tilt. But it takes a long time to see, and you kind of have to be really digging into it. And you've got to understand, what's the information that they have. Another thing is, you observing me, you might not, you don't have complete information. You don't have the information that I have as I'm making the decision. Can't see my cards. My line might look totally reasonable to you unless you saw my cards every single time. If you saw my cards every single time, it would be easier. And you're not necessarily looking for it, because the low vol choice doesn't necessarily look like a bad choice, because it could actually be a positive EV choice. It's just not, I'm just not maximizing my EV.
You've brought up low vol multiple times, and I keep thinking of a kind of a market trading thing that I say to people, that if I see a trader, an investor, and if I see a long-term track record and it's 1% gain each month, every month, year after year, year after year, I say to myself, we either have Bernard Madoff or long-term capital management, the hedge fund that went belly up in the 90s. So just the idea of a consistency actually raises a red flag to me.
Exactly. People don't understand that should raise a red flag. They don't get that. And in fact, when they're looking for places to invest, they tend to be looking for consistency, which is exactly where they shouldn't be looking. That's exactly the point. Exactly right. And it's a very good example of exactly where you see that problem and how people don't understand why that's a problem. I can name tons and tons of poker players who sort of consistently won a little. I would have never invested in them. I would have much rather invested in somebody who had higher volatility, where I understood that they were playing at a positive expected value, but they're always going to win more. The question isn't always, is somebody playing at positive expectancy? Is somebody maximizing their expectancy? And sometimes people temperamentally are those type of people who sort of, are kind of low vol types. They don't like risk. They should probably find a different business than the kinds of businesses we're in, but they just don't like risk. But a lot of times people are very smart and risk takers, and they understand how to manage risk well, and then they lose. and they just emotionally don't handle losing well, and they don't recover from it. And all of a sudden, they're low vol types. You don't spot it. It takes a really, really long time to spot. And it's incredibly hard to repair. That's the kind of tilt that I actually think much more about than the other kind of tilt. The other kind of tilt you can really see. It's easier to clamp somebody down than ramp them up. It's easier to get them to go from being, too crazy to a little more conservative. It's easier to get somebody to go in that direction. And it's easier to say to somebody, hey, dude, you're out of your mind right now. Like, walk away from the table. Calm down. Stop playing. Get off that position. What are you doing? Because I can see it in one time. I can see it in the moment. I don't need to see a pattern over a long time in order to know that the first thing is happening. So that's just much less dangerous.
You teach. You've taught people poker. You're now helping executives outside the poker world, men and women. Talk about this very dense, layered subject that includes math, psychology, game theory. How does this translate from a teaching perspective to men and women? And if I'm guessing that there might be some less interest in women, maybe you're going to correct me on that, but I'm wondering if your touch, being very accomplished female at all these subjects, do you find yourself having an advantage in getting these points across to women?
Oh, that's an interesting question. I
try my best.
Yeah. I've actually never been asked that. I've been asked a lot of different things about stereotype tax, for example, how women should deal with being in a man's world and the way that they're perceived and that kind of thing. I've been asked a lot of that, but whether these concepts, I deliver them better to women because I'm a woman, I've never been asked that before.
You teach guys, no problem. I mean, I'm assuming. Guys will listen to you and they're going to be like, okay, some trader
to listen to me. Yeah.
Okay. And there's, I'm guessing in a population, and it obviously, I know, look, one of the most successful hedge fund managers in the world right now, I think she runs around 10 billion. It's all quantitative. If we were to talk right now and have her in this conversation, she would be talking EV2. So clearly there's some very successful female minds in these areas, but I'm just gathering, at least in my experience so far, there's just less. And I wonder if that's an exposure issue, I'm guessing.
I would say that it's actually two issues. So I've always said it's a combination. Men and women's brains are different. We had different roles as we evolved as a species. I think that that math and space are related to each other. That's obvious from geometry, I think. Men were hunting and women were gathering in general. The way that you're dealing with space is very different between the two. So it's actually true that women in general, their brains are going to be built more for communication, verbal stuff, because they're talking to each other and raising the babies and that kind of thing. And in no way is this sexist, right? I just want to make clear I'm talking about like a million years ago right now. I want to make clear I'm not saying that this is what they're supposed to do. This is a million years ago. This is the females in the group, were staying sort of more closer to the camp and raising the babies and having to communicate with each other. So women tend to be more verbal. And the men were doing the big hunts, that kind of mathematical relationship of, how are you organizing that? Men tend to be more mathematically minded, but obviously there's tremendous variation, and there are lots of incredibly brilliantly verbal men, and there are incredibly brilliantly mathematical women. Why don't we have more is that I think that there's an interaction between if you're Bayesian, like what's the base rate of abilities happening, and then when you add society on top of it and what's encouraged, I think now you get into a really bad interaction. So I know that in my case, when I was growing up, I was doing a lot of math in high school. I took calculus in 11th grade, calculus 2 in 12th grade, and went to college, and one of my majors was English, which was really, I mean, it's fine. Like I read a lot of really good books, but someone should have said to me at some point, hey, did you notice that you're the only girl in this calculus 2 class? That's an advantage for you. And when you go to college, you might want to continue in something mathematical. Like, I wish that I could have gone back and been a finance major or something to do with math. But instead, I got told, I won't say by who, but I got told, don't let anybody know that you're smart at this because they don't like girls like that. Which sounds crazy, but, that's what I was told. And whether people are saying that out loud now, I think that there's still this idea of like, if you're a mathy girl, that you're somehow like unattractive or a nerd, or it's not desirable. It's not a desirable quality, that the artistic ones, those are it is terrible. And I think that it's definitely changing. It's certainly not anywhere where I was when I was growing up. And certainly even when I was growing up, it was better than, say, when my mother was growing up, right? So I think that we're making a lot of progress with that. But I think that there still is this big divide in sort of what people think, oh, these are the jobs that women should go do, right? Like women should go be in PR or marketing or human resources or that kind of thing. I don't think people are pushing women to go, oh, you should be studying finance or even accounting or go be a math major. I don't think that people are pushing women into those jobs. People tend to push women and encourage women into the jobs that are more in the communication world.
In the last couple of years, I've been in the boardrooms of major mutual funds and hedge funds from all across Asia, but I'm thinking in particular off the top of my head to Singapore, Kuala Lumpur, and Beijing. And each time I was in those rooms giving a presentation, by memory, it was 50-50, men and women. So I find it very different in Asia.
Yeah, that's why I say I think that there's this cultural issue, right? That if the question is, what are you encouraged to be doing? I'm sure that you've been in front of boardrooms in America, and I'm guessing it wasn't 50-50. Yeah. I'm taking a wild guess. That
back to the beginning of that question, the part that you like, though, as we wind down here, do you find, though, that given this really great background that you have, this perception that arguably not as many women have as men, do you find that when you introduce your way of thinking to women, maybe they might not want to listen to the male teacher, so to speak, but do you find that you connect, or is that just kind of tough to say off the top of your head?
It's a little tough to say off the top of my head, but certainly when I've talked to rooms that are just women, and I think that they do hear my message really well. And I think that they do like, I think that for women, because it is the case, I think that those percentages are very different in America, that when women see that here's this woman who went into a world that's very predominantly men, in fact, among professionals, 97% so, and did well, was at the top of, that world. And here's the way that she thinks. I think it is an easier message for them to hear. I think that whether it's explicitly said or not, I think that women are frustrated by, you're going to go over and do the art, and these guys are going to go over here and do the experiments. Again, less so, but the more that we can get women going into STEM, I think that women bring a different kind of thinking to it that I think is really important for advancement. Women and men think in a different way, and when you get a woman's mind that's mathematical being applied to the same problem as a man's mind being mathematical, it just makes everything better when you get both perspectives working. And I think that you get more precise thinking and more innovation when you combine the two mindsets. I'm hoping it will be 50-50 in America soon. And whatever I can do to be helping that, I'm happy that I could be doing any contribution to that at all. I don't know if I am, but I'm hopeful that I would be.
Annie, I could keep peppering you with questions. Hopefully, maybe I can have you on again in the future. But where is the best place that we can send people today to check you out, follow your world, perhaps make contact?
I have a website, annieduke.com. There's blogs on there and speaking topics and a way to contact me by email or by phone. People should look, hopefully, by winter of 2016 for a book that I have coming out on these topics. It's a little over a year away, but hopefully people can keep their
I can tell you right now,
and
the trading world that I'm in that would just eat this stuff up. So make sure the publisher is focusing on that audience as well, because everything that you talk about is in the exact slipstream of the trading world for sure.
Yeah, I speak to a lot of traders. So I do a lot of hedge fund retreats and then a lot of investment firms on these topics. I think that there's so much overlap in terms of the kinds of problems that traders are facing. And actually, here's just kind of a funny story. I was doing my PhD work at Penn, decided right at the end that I wanted to sort of think more about whether I wanted to go into academics, ended up becoming a poker player. Started playing professionally in 94. In 2002, a friend of mine, Eric Seidel, very, very, made, one of the best poker players ever, got asked by a friend of his named Roger Lowe, who had a fund out in San Francisco called the Parallax Fund, to come. Roger was doing a retreat with his traders. He knew Eric because Eric at one point had done some trading. He said, hey, will you come and speak to this retreat of traders that I'm doing? And Eric said, well, I'm not that good a speaker. He doesn't really like being in front of audiences. He said, I don't really like speaking, but I know someone who used to be a teacher, and you should have her come and talk to your group. It had never, I hadn't really thought about, someday maybe I'll be teaching sort of these concepts that I think about in poker that are a real crossover with the behavioral economics and behavioral finance world. So this was completely accidental. So Eric called me up and said, hey, I've got this friend. He really wants someone to come speak to his traders. Will you come do that? I was 2 weeks from my due date of my last child, by the way. So I was incredibly pregnant at the time. And I said, sure. I went and spoke to these traders. I actually couldn't wear shoes because my feet were so swollen at that point, because I was really due to have a baby. So I came in, waddled in, incredibly pregnant. The first talk I ever gave was on tilt, actually. And I talked about this issue that I just talked to you about of, you can see this, this extroverted tilt, this tilt that's really on the outside, but the stuff that goes on that's kind of over the long term, that's internal, it's hard to see. And I remember the example that I used was, if you have a head coach who's calling a short pass all the time, and he's never throwing it all the way down the field. So he's always handing it off to the running back or doing the short out. Obviously you really wouldn't want that person as a head coach, but he's going to be completing a lot of plays, right? He's going to be gaining yards. It's just that that's not the guy that you want, because there's all sorts of problems with that. And I remember using that example. So I spoke to his traders. I made a little money doing that, and that seemed kind of interesting to me. It was the first time that I'd really thought about it in any kind of regimented way, with any kind of real clarity, where I was really trying to think about how would I express these concepts. And it was the first time that I realized that, you have the normative guys and the behavioral guys. And obviously, as a poker player, I was sitting over in the behavioral camp, because when you have a game where people are exchanging money hand to hand in front of their competitors, with 30 seconds to make every decision, all you see is the behavioral stuff, right? All you see is the irrationalities, and all you're thinking about is when people are irrational, how do you exploit it, right? So you've got this underlying math happening, which is certainly normative, as you're trying to figure out, am I getting the right return on investment? But most of what you're thinking about is, what is this person's set of behaviors and sort of set of irrationalities, and how can I exploit it to my best advantage? So you naturally become a behaviorist when you're in that world. But it was the first time that I thought about it with any clarity and in any real way.
Thank you for coming on. And like I said, you're always welcome, and hopefully we can chat again.
Well, thank you. And I really appreciate you hunting me down and stalking me. No, you didn't really, but
I'm at least 8,000 miles away, so it's a very subtle stalk.
Yeah, to be fair. But I have to say, like, I'm incredibly passionate about these topics, and I love talking about them. And if I could change one thing in the world, just one, it would be to get people to think more probabilistically. And the more that I can get that message out and the more that I get to discuss these concepts with people, it brings me incredible happiness.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.